Guys, in this video I'm going to be showing you how to build a discounted cash flow model. I'm going to use Amazon as an example in this analysis. So we're going to call it Amazon discounted cash flow model. And then we need to make some assumptions. So in this example we're going to use the growth rate, the projected growth rate of the free cash flows. We need to know the terminal growth rate, which is the long-term growth rate. And then we need to know the discount rate. The discount rate, that's what you're going to discount your cash flows by, because a dollar today is worth more than it will be in the future if you just held it in cash, because you could invest that dollar, say, in a stock market index and earn more on that. We're going to use what's called, we're just going to use the corporate bond yield, and I will dive into that more later in the video and how that pertains to this discounted cash flow model. Okay, so, and then we need to project what the free cash flow is. So for Amazon in 2019, they projected, well, they're going to earn $20 billion. Okay, and then in this example, I'm going to use 10% as the growth rate. I'm going to use the long-term growth rate of 3%, also called the terminal growth rate. I'm going to use that. That's the long-run inflation rate, pretty conservative metric when analyzing a company like Amazon, high-growth stock. The discount rate, I'm going to use 9% because that's the long-term annual appreciation of the S&P 500 index over the last 100 years or so. It's been about 9% before inflation. And then the corporate bond yield, I'm going to use 4% in this example. Right now it's about 2.5 to 3, but kind of over the last 5 years it's averaged somewhere around 4%. So we're going to project our free cash flows here. Okay, and then we're going to start in 2019. And then I'm going to pull this out to 2030. And then 2019 will be year 0, year 1, year 2. And then we'll pull that out to, well, we're going to do 10 years in this example, out to 2029. So, okay. And then I'm going to pull this out and label these. Okay, so in 2019, we're going to use 20 billion. And then what you're going to do for year 1, okay, is you're going to, that's equal to 20 billion multiplied by 1 plus the growth rate. Okay, and we're going to anchor that. So you need F4 to do that. Make that parentheses. And then we'll pull that out. Sorry. Wait. Yeah, so, okay. Pull that out here, like so. And then I'm going to make these dollar amounts. Okay, and then these are the projected cash flows, free cash flow that Amazon would be projected to earn over the years up until 2029. So we'll call this free cash flows. And then we need to determine the discount factor, because again, all of these cash flows, we've got to discount them back to the present to determine what the fair market value of Amazon is at the present time, given all its future free cash flow earning potential. So in order to do that, what we're going to do to get the discount factor is we're going to take 1 divided by 1 plus, again, the discount rate. In this example, we're going to use 9%. Again, we're going to anchor that. And then you've got to discount it back to the present, so we're going to take to the number of years, we're going to make that an exponent. So in this case, that's going to be 0. So today, you know, those free cash flows haven't been discounted. So 20 billion today is worth 20 billion right now. That doesn't change. And then we're going to pull this out to year 2029 to get the discount rate. So you can see there, we're going to make those percentages. So to illustrate here, in years, say year 9 by 2028, based on a 9% discount rate, $1 would be worth about 46 cents if you just held it in cash, because you could take that dollar again and invest it, say, in the stock market. So we've got to discount these cash flows. So then what we're going to do to get the present value, I'm going to call it PV of discounted cash flows, and we're going to multiply, again, the nominal free cash flow, and we're going to multiply that by the discount factor, okay? So 20 billion again is worth 20 billion right now, and then if you pull that out to year 10, there you go. So those are your discounted cash flows, okay? And then we still have more to do here. So in this example, what we need to do is get the free cash flow in year 11, which in this case is going to be 2030. Okay, and how we're going to get that is we're going to take the nominal cash flows of 2029, which is projected to be, you know, if Amazon can keep growing their free cash flows at 10%, it'd be about $51 billion. Okay, and then what we need to do is multiply that times 1 plus the long-term growth rate. So in this case, we're going to say the terminal growth rate is 3%. So it'll be 53 billion, okay? And then here's where the corporate bond yield comes into play. So we're going to take that, again, that corporate bond yield. In this case, it was 4%. Okay, and then what you're going to do to get the projected market cap of Amazon, ticker AMZN, in 2030, you're going to divide, okay, that free cash flow, projected free cash flow in year 11 by the corporate bond yield, because that's what, you know, hypothetically, you know, they might be paying a dividend. That's the earnings yield that you could generate off the future free cash flows. So that's a big number. So we're going to project based on this model that based on the corporate bond yield that Amazon may be worth somewhere in the range of $1.3 trillion. Okay, and then what we need to do is discount that rate back to the present. Okay, so what we're going to do here is get the present value, and we're going to call this present value of the terminal value. So projected market cap can also be called the long-term value of the company. So we're going to take this, and again we're going to divide that by, multiply that by, so here's what we're going to do to get that. So to get the discount factor again, we'll call it year 11 is equal to, again, 1 divided by 1 plus discount rate of 9%. And then since this is year 11, we're going to make it to the 11th power. So there you go. So it's 38%. And then we're going to take that 1.3 trillion, multiply it by the discount factor in year 11. So you get 517 billion. That is what's projected, the present value of Amazon's market cap. Now, we've got to add, because the value, right, of any given stock is based on the projected future earnings, especially a growth company like Amazon. So we've got to add that to this analysis, okay? So to do that, it's pretty simple. We're going to take the sum of the present value, or sum of the discounted cash flow, sum of the, we'll call it DCF, sum of discounted cash flows. So we're going to take the sum of, and again, these are all the, see right here in row, yeah, PV of DCF, that's present value of discounted cash flow. So we're going to take the sum all the way up to year 10, 230 billion, okay? And then to get the implied market value, or let's call it equity value, implied equity value, we're going to add this 517 roughly billion plus the sum of the discounted cash flows. We had implied equity value for Amazon stock of about 748 billion. Okay. Now, if we go, I'm going to go look here at FinViz. Give me a sec. So there's about 496 million shares outstanding. So we'll go back to our model here. So Amazon shares outstanding. And that was 496,444,000. Okay. And then to get the implied equity value per share, we take that 748 billion divided by the shares outstanding, 1506. 1506.79. Now the current Amazon share price is 1778. roughly. Call that current Amazon share price. So you can see here on this model, right, that if we project that Amazon's going to grow its free cash flow by about 10%, which is, that's fairly, probably, I would say that's about right for a growth stock like Amazon. Most of these I like to stay conservative, and if we assume the long-term growth rate of Amazon stock at about 3%, it's good to stay conservative with these, but I think that's about right. You can see that, based on this model, the market's pricing in that Amazon's going to, grow its earnings at more than 10%. So, we can see here if we were going to, thinking about making an investment in Amazon stock, based on this, it would appear that Amazon may be overvalued at the moment, based on these cash flow projections, and so there may be some downside in the stock. Hard to say exactly. But I think this just gives you a good sense of how to value a stock using discounted cash flow, which is what many investment bankers, many analysts, they use these projections, and it gives you a good way to determine what the fair market value of a stock is. Now, keep in mind these projections, they can be very sensitive to the inputs that you put in here. But I think it gives you a great sense of how to value a stock, and so just be mindful of what kind of inputs you're putting in here. And again, I think the best way to these they work the best for companies that have a long-term track record of generating stable cash flows. Now Amazon's kind of in the it's starting to become, some people call it the cash cow phase, where it's maturing. Sales are growing, and it's able to generate those excess cash flows. So hope this helps you guys. If you have any questions, feel free to comment in the section below. Like the video, and we'll look forward to seeing you here in a future video.